I'm Michael Fox, and this is the Prospector News Podcast. And I have returning with me longtime guest, friend, and colleague, Chris Temple of the National Investor. Welcome, Chris, just before the long weekend.
Yes, happy belated Victoria Day to you, and happy early Memorial Day to us down here in the U.S. of A.
Yes, I'm not sure how happy it's really going to be. Like, I see storm clouds and a tipping point, and almost like the three horsemen of the apocalypse riding down upon the economy right now. We've got, the Fed, saber rattling for more interest rate hikes. I see inflation starting to rear its ugly head again. And the bozos in Washington look intent on defaulting on the national debt, although they're allegedly making progress in negotiations.
Well,
Selling may go away. I'm not sure this time.
well, I thought so, when the month started, but as we're seeing ending this week right now, none of those three horsemen are spooking the resurgent bulls on Wall Street whatsoever. The market is ending this last full week of May with a bang, big rallies. The NASDAQ recently moved above its double top, so arguably is broken out. This S&P 500 is trying valiantly to do it. We'll see where the close is on Friday. We're recording this a bit before the close, but if you get a close much above 4,200 for the S&P, that'll be the highest close of this rebound, most likely. So the bulls will be all excited over that. And yet it comes, as you point out, with this week's numbers showing, the good part, I guess, economically, Mike, that the economy is still doing better than a lot of people thought it would by now. Q1 GDP got bumped up with the first revision from 1.1 to 1.3%. This week's economic news on durable goods and some other things, consumer spending, is making the case that Q2 might actually be a bit better than that, when it wasn't that long ago that there were some views that Q2 might finally turn negative again, like we had early last year. That probably won't happen. You look at the plans for the Memorial Day weekend down here, and we're going to have the busiest travel weekend for Memorial Day in several years by all appearances. The CEO of United Airlines was just beside himself in an interview a few days ago, hearing the cash register ringing for all of the business that they're going to have this weekend. So, you've got that. You've got core inflation turning back up again with some more numbers this week. And though Jerome Powell himself, at a symposium he was at a week ago with former Fed Chair Bernanke, was hinting that maybe the Fed is ready to pause, everybody else on the central bank, aside from him, other than that speech, has come out either saying we're going to keep going now, or maybe we'll pause and then have to restart. So everywhere you look, the realization is there that the Fed is not done raising interest rates. Whether it does at this coming meeting remains to be seen. Probably will. But here again, none of that, the debt, wrangling down here, the rest of it is putting the bulls off very much.
No, the market seems to be somewhat disengaged with reality. They seem to think that there's a Fed pivot coming, yet the Fed keeps saying they're going to raise rates more. Inflation remains higher. The standard thought is that the interest rates from the Fed have to be greater than the inflation rate in order to have an impact on inflation. And yet the market seems to price that the interest rates are going to go down. I don't know. I don't get it. Is the market seeing something I'm not?
Well, the interest rate situation in recent days has reversed somewhat. We've seen interest rates across the yield curve move up notably. We were tickling. I didn't see where it's at this afternoon, but we've been up with 1 month treasury bills to darn near 6% this week. And you go out on the short end of the spectrum, we're still well above 5%. It's only the longer dated ones that have some pricing built into them that they don't believe that we're going to have sticky inflation for terribly long. So, the 10-year yield is still far from its peak of last year, which was around 4.3%. Ditto the 30-year bond. I think that it's inevitable that we get those longer maturities before too much longer back up in that neighborhood, and that might finally knock some of the wind out of this resilient stock market. And we need to remember too, Mike, and a lot of people have reported on this, that this stock market rally, when you look at the NASDAQ 100, you look at the S&P, which has not done as well as the NASDAQ 100, it's being led still by a relative handful of stocks. And when you look underneath the surface, you don't have that much strength. You look, and one of many examples we could cite is that in recent days, Apple, which I think is more deserving maybe than some of the old fang stocks, if you will, with the rally that it's had, but its market cap has now gotten it up to where it's greater than the entire market cap of the Russell 2000 small cap index. And it shows you how much the big money is out there with their algorithms and whatnot. And again, it's just momentum chasing. It's Pollyanna's thinking that nothing bad's going to happen. And, eventually they're going to be proven wrong. But, the old saying is, especially for people who are aggressively shorting this market because of the economic fundamentals, that old saying is that the market can remain irrational longer than short sellers can remain solvent.
Yeah, that's definite. Now, there was a big hoobah meeting with the Fed, and Bernanke joined the crowd and was part of the speech, and he was quite hawkish. Is he starting to lobby to get his old job back, or what's up with that?
Well, I don't think he's lobbying to get his old job back. It's always easy for, Fed chairman after they leave that position to talk tough and act like they're going to be, advocates of sound money. I remember Greenspan, who for so many years was a gold bug, he becomes Fed chairman and really is the one that started to open the floodgates of the lunacy that we have these years. The man never met an unregulated derivative contract that he didn't like. And he really, even though on hard numbers, Greenspan never inflated the money supply like Bernanke subsequently did, and especially like Powell did in the last few years before he reversed. Greenspan, nonetheless, still has the title of being the greatest monetary mad scientist of all of history, with all of these newfangled tricks that he allowed to flourish, like unregulated derivatives and the rest. So Bernanke is trying to do that now, acting tough and warning that the Fed is not done raising interest rates, that there's a new normal that the Fed is now fighting on inflation. We're going to have chronically higher and sticky inflation, and the Fed's going to have to be more aggressive. In fact, the only one in the recent past who sounded a little bit dovish was Powell at that same meeting. I don't know if they had this choreographed ahead of time, this good cop, bad cop kind of thing. Powell was intimating that, it's a coin toss as of right now, whether they raise rates in June or not. But almost everybody since him, especially with this week's stronger numbers, is indicating that there's going to be a rate hike again in June, more likely than not. And maybe that won't even be the last one. A couple of Fed governors and bank presidents are talking 6% now. Will be closer to the end than 5% where it's at right now. So we'll see. But, I guess Bernanke is feeling like he can talk tough and act like an advocate of sound money, given how he won the Nobel Peace Prize a while back, or not the Peace Prize, the Nobel Prize for Economics. I guess you ruin enough stuff and you're part of the establishment, you get rewarded like that. But I loved your quip about Bernanke when he got that.
Yeah, that was tantamount to giving Jeffrey Dahmer the good housekeeping seal of approval for a cookbook. Yeah.
It's about the same, and someday maybe Powell will get it, after we've seen much more damage done to the long-term financial health of the country, and the debt by that time will probably have doubled again. It's just crazy the world that we're in. But no, it's become very, very clear. Let me give you, in fact, I'm looking it up here right now as we're talking, a quick rundown. And what's interesting is, besides the rundown I gave, on the higher inflation numbers and the better economic numbers, and really the Fed is not getting much yet that it wants to get for all of the 500 basis points of rate hikes to date. In fact, it's most notable that when interest rates were 0 to 25 basis points, the unemployment rate was 3.6%. The Fed finally belatedly started raising interest rates. Now we're 500 basis points higher on the federal funds rate, and the unemployment rate is lower at 3.4% than when they started. Now, I'm not one who believes we need to live with this Hobson's choice of, in order to get inflation down, we've got to throw lots of people out of work. Unfortunately, that's the world that we've been put in by the nature of the Fed itself. We have no choice in the matter. And if it was up to me, of course, as you know, we wouldn't have a Federal Reserve, and we would have a very different monetary system where strong employment and strong wage gains were not a bad thing, as the Fed sees them now. But that's where we are. But you look at all of these different Fed governors and bank presidents, the two most notable doves on the Fed, Kashkari from Minneapolis, and then Austin Goolsbee, who used to work for Obama, I believe it was. Goolsbee says, I'm not sure we've restrained the economy sufficiently yet. Kashkari is saying maybe we'll get a brief pause to see how everything is going, but that he still thinks that the Fed's not done raising rates. Because here again, the things are too strong. Bullard from St. Louis, who's the biggest hawk, like I alluded to a minute ago, he's suggesting now we're going to be closer to 6%. And if you look at the biggest and most powerful unelected and non-Fed banker, of course, it would be J.P. Morgan's head, Diamond. And he says, don't be shocked if in the end we're at a 7% federal funds rate. For the Fed to finally get inflation under control. So this isn't done. And, again, like we alluded to, at the top of the show, I don't know when this light bulb goes off over Wall Street's head, but inevitably it will.
Yeah, no, definitely. I'm in the camp where they're going to raise at least twice more. The economic data remains strong. So their attempt to diminish things isn't really working. Inflation's starting to increase again, and my position all along is, until the jobs market starts to deteriorate, I don't think they're going to stop raising the rates to fight inflation. And as you mentioned, the unemployment rate's actually gone down since we were since we were at 0 rate versus the 5% that we're at now. And I just continue to see them trying to fight inflation, try and put that particular genie back into the bottle.
Well, of course, this is a problem, as we've talked about many a time, of their own making. The Fed put themselves and all of us in this predicament in the first place by creating roughly 1/3 of all the US dollars that have ever been brought into existence in the history of this country inside of about 2 years. And now trying to figure out how to mop all that up without, destroying things. There was a lot of us. And to be fair, you go back 14 or 15 months when the Fed first started raising interest rates, and some of us figured, okay, well, it's about time, but what are they going to break along the way? And yeah, we've seen a few examples in the recent past of banks that went belly up, but the depositors were covered. A lot of the investors and bondholders had to eat the losses. that pattern's going to continue. There will be other things that break as we go along. Diamond said the same thing. Of course, his bank has been a big beneficiary of that. JP Morgan, I mean, they're in Fat City, but it's not going to do a whole lot of good for a lot of banks down the food chain as the Fed keeps raising interest rates. A lot of the banks continue to bleed money. It came out, I think it was this morning, in fact, that money market fund balances have hit a new record of 5.4 trillion. That does not count money that is invested in short-term treasuries outside of money market funds. So, the banks are bleeding money, and that's not going to stop. They can't keep up with what people are able to get in treasury bills and the like. So, we're back at that same question, asking ourselves, even from this point, Mike, okay, well, the Fed's already enacted all these rate hikes. They're probably going to do a few more. Do we need to still worry about them breaking something? Or is there still, as we've seen in the recent past, clearly so much liquidity that they can get away with a few more rate hikes to try and take some more of the steam out of asset markets, take some more of the steam out of consumption until they finally get where they think they want to go? I still believe it's a tall order, because in different conversations you and I have had, we've talked about all of the structural changes in the world and in the economy that are not going to allow the Fed, or any of the other central banks for that matter, to bring inflation back down to that, they're all desired 2% core measures. It's just not going to happen. It can't happen mathematically unless we had just a complete breakdown in a global depression. And then, even then, you would only have a price collapse back down to their target or maybe below temporarily until things got reinflated again. So, I mean, you look, for example, in the US, if you go back to last year's peak of core, the core CPI, it's been cut from over 9% to something like 4.5% or whatever it is right now, which is about where it's, I figured this was going to happen. We would flat line at 4 to 5%, get stuck there, and if anything, rebound from that point. It looks like that's what's unfolding. But the UK, it's still at 4-decade highs. Europe, it's still at 4-decade highs. Japan, inflation is at 4-decade highs. Still, they have not come down from their peaks, any of them to speak of. And if that continues to linger, our global bond market's going to stay behaved, or are they going to get to be even more like we're starting to see some glimmers of in the US, where rates do finally pop back up despite the varying efforts of central banks to keep them suppressed?
The political class in your country is trying their damnedest to break the bond market by defaulting. Janet Yellen, suggests that it could happen as early as next week, although nobody's really sure what the drop dead date is, because there is ways to continue to kick that can down the road for a while longer. But the Fitch credit services, they put the U.S. economy on a credit watch, and I think some of that has to do with the short-term rates increasing. Would you not think so?
Well, I think some of that does, for sure. I don't want to overstate this either. If you go back, well, first of all, Janet Yellen is a politician. She's not an especially bright person. In fact, when anybody has ever listened to her give her various congressional testimony, it strikes me as if somebody, the shadowy hands of power behind the scenes in our government, went out to some city and looked for some lonely old bag lady living underneath a bridge and dialed her up a little bit and threw her in front of cameras and say, here, talk about inflation and monetary policy. She's really a nitwit. When you listen to her, it's astonishing that this is the nature of our so-called leadership. But when she's said recently, with all of her various warnings of how we're in dire straits and we're doomed if Congress doesn't raise a debt ceiling, we run out of money. And I should add, that didn't stop her recently from going to Ukraine and promising zillions of dollars, and even promising to help on Biden's behalf to underwrite retirement plan markets of all things in Ukraine. So they can't be that worried about it. And I think an indication of that, Mike, is what they still throw away on all manner of things like that. But when she commented that the U.S. hasn't defaulted since, during the Revolutionary War years, that's a lie. And most people know it, that know their history. The last official default, even though it didn't last long and was made up, was as recent as 2011, when Obama and Congress couldn't come to terms right away. You did have a technical default. A few things got rolled over, didn't get paid for, I forget how many days or a few weeks it was. Then it got cleaned up. And guess what? That's what's going to happen this time too. So I don't think people are all that worked up about it. That default briefly back in 2011 did cause Standard & Poor's to lower America's credit rating from AAA to AA. Fitch, as you pointed out, has threatened to do the same thing, depending on how this turns out. But even if that happens, the US dollar is still the world's reserve currency. It's still got the deepest and most transparent financial markets. And where the hell else are people going to go? Europe's a basket case. Rates aren't as high in Europe. Japan has got rates still suppressed, although you wonder, this beach ball that they're holding underwater keeps getting bigger. I don't know when that's going to break. And China's got the highest debt to GDP ratio when you count public and private debt on the planet, more than double what the US has. So this is all a lot of noise, a lot of politics for everybody to, if you're a Democrat, you're getting all kinds of fundraising letters to fight the evil ogre Republicans who want to cut and gouge social programs. And if you're a Republican, you're getting fundraising pitches from the usual suspects on that side, telling you that we've got to stop the big spenders. Of course, Republicans didn't care about big spending when Trump was president, and they don't care about big spending when it comes to occupying the whole damn world with the military. So it's a show.
Yeah, I'm going to put my nerd hat on for a second and say it's like the Ferengi rules of business. Rule number 5 was war was good for business. You know what
Sure.
rule number 6 was? Peace is good for business. It's kind of like that. So this is kind of good for both sides until it's not. And then both sides will suffer, right?
Yeah, pretty much.
So,
I still don't see us getting to that place. I think that the whole exercise on both the Republican and Democrat parts is very hypocritical. A lot of what has gone on, a lot of what is said during this whole thing, it's a joke. The problem is not the debt ceiling. The problem is not that all of a sudden now we're going to have this epiphany that we've got to, tighten our belts and so forth. That ship sailed a long time ago. And frankly, to me, this is one of the many reasons why I think the Fed needs to be abolished as an institution, because once upon a time, the Fed, with some of the better things that it did not enable profligate spending. And it was only when in the early 80s, Paul Volcker did a total 180 and enabled the fostering of asset inflation bubbles, which have only been fed since then. And then when that got out of hand, we started quantitative easing and all that kind of thing. It's only been since the Fed became the enabler of more and more spending and deficits that things really got out of hand. And it's why there is no responsibility from either party, really, when you get right down to it. There's a handful of exceptions, of course, mostly in the Republican Party these days, certainly not among the Democrats that I know of. But when the Fed...
there's Manchin and Sinema who aren't necessarily true Democrats, right?
Yeah, they're less bad. You're right. But by and large, if the Fed did not accommodate these deficits and monetize the debt, then we wouldn't be in this place, because the marketplace would so rebel against the US government in that type of a circumstance, and interest rates would shoot up because of these deficits like they did in the late 70s and into the early 80s, that alone would force uh, the government to live more within its means. But the Fed long since enabled this behavior. And what's absurd about it is that the Federal Reserve, by its charter, is prohibited from monetizing government debt. And their excuse has been, since they started doing it, and Powell has said this a few times in the recent past in his congressional testimony, well, this doesn't count. Quantitative easing doesn't count because it's temporary. And eventually we're going to get rid of our balance sheet. We're not going to own any government securities. Okay. Anybody believes that, I got oceanfront property in Missouri to sell you.
Well, I believe income tax was a temporary measure to pay for a war back in, the 1900s. So,
yeah, so look, we're already way past the point at which, we need to talk about reining in spending and stuff like this. As long as we've got this situation where inevitably the Fed is going to monetize some of this and make interest rates less bad than they would be if the market was fully in charge and the government was fully accountable to market forces, then this will never stop.
no, but at some point you have to wonder when this gets into banana republic kind of areas where, the only person buying your bonds is yourself. So you're financing your own debt.
Well, Japan is about there. There is still some role that the markets play in JGBs, but it's minor, certainly minor compared to treasuries, where you've still got, there's still, I think it's somewhere in the neighborhood of 70% of all treasury paper is not owned by the Fed. It's about the opposite of that where the JGB market is concerned. They've got the majority of it. Some people suggest that through various financial devices, which I'm not going to claim to understand, that the Japanese central bank has it all under control. I don't know. It certainly sure as hell looks like it when their inflation is at a 40-year high of somewhere between 4 and 5%. And 10-year JGBs are 40 basis points or thereabouts.
Yeah, well, let's look a little bit to the future here. So we've got all sorts of stuff happening. So Fed rate hike, another quarter point next month.
Oh, I think the odds favor it. It's not a sure thing. If for sake of discussion, Mike, we get to the next FOMC meeting 2 weeks from this week coming up, and there has been a bigger debt debacle and the markets are quivering a fair bit, that'll be an excuse for a pause, which some of them want to do anyway, to sit back even if they still think they may have to raise rates further. But if the debt thing does get resolved without any problems, and especially if the stock market is still rallying, and the May payrolls, it'll come out next Friday, are strong, then yeah, they're going to raise rates another quarter point at the next meeting, and that still probably won't be the end of it.
So debt default, you say they're going to reach an agreement before we get there, or if it happens, it'll be short.
I think so. I don't see this going on for a long period of time. For all of his claims to the contrary, Kevin McCarthy is still more of an establishment guy than not. So, I don't think that there's anybody that wants to really go to the mat and die on this particular hill. If anybody does, and this is going to be one of the interesting dynamics politically to watch down here that a couple have talked about, you've got a lot of the more liberal members of the Senate who are going to vote against any deal that in any way, shape, or form cuts a lot of the programs that even Biden has suggested could be on the table. So you could see, uncharacteristically to this point in his presidency, the Democrat Party, not the Republican Party, foil Biden's negotiating position. So that's still a work in progress. We'll see how it happens.
And finally, although we didn't really talk about it, we kind of grazed the surface. The banking crisis, is it done, or is there still some more folding to occur?
Oh, there are going to be other banks that go, guaranteed. No question about that. And it's the number will increase, I think, substantially over time. What everybody seems to be betting on, and not without some justification, although you never know which accident is going to be the straw that breaks the camel's back and things really get out of hand. But as I've said before, I do think that we're going to see an epic deleveraging ultimately when the Fed gets its way. It hopes it's going to be orderly and prolonged and manageable. It's going to be, as I've said, I think a slow, dull ache, not a quick, sharp pain as we had in 2008. So yeah, we'll have a deleveraging of sorts like we did in 2008, but this is going to occur over a number of years, most likely. And part of that will be a lot of banks are going to go under. But the pattern has already been set. So investors sure as heck have already been warned what the outcome is going to be. If banks go under, the feds are going to backstop everybody. The FDIC is an anachronism. They might as well just shut it down because it really doesn't matter anymore. So depositors, the hoi polloi are going to be protected as far as their deposits go, but to the extent that there are losses by stockholders and bondholders, those investors are going to have to eat those losses. And that alone is going to inevitably lead to a reduction somewhat of animal spirits, as it's called. You've already seen a fairly significant tightening of credit conditions for businesses, although a lot of people counter with the fact that where consumer credit is concerned, there hasn't been anything to speak of as far as tightening yet. You got 500 basis points of increases of short-term interest rates by the Fed, some corresponding bumps up in consumer credit interest rates, although they already are high, a lot of them. But really, not much of a dent yet has been put into the consumer credit market, but businesses are going to feel it more. Commercial real estate is going to be in trouble. Here again, you're going to have one by one, you'll have rolling defaults and bankruptcies and whatnot. And the feds and the powers that be just hope that it's not everybody at one time, because if that happens, now you got a different ballgame.
Yeah, well, I think you're going to see the FDIC is going to become the Federal Delinquent Institution Commission, because the only thing they're doing is figuring out which of the bigger banks get to eat the little guys.
Well, a mentor of mine seems like a couple lifetimes ago at the beginning of my career, he used to refer to the FDIC as the fraudulent and deceptive instillers of confidence.
That's another good acronym. I'll have to remember that one.
Yeah, I don't know if anybody in our audience would even recognize this name, but this was the late Bruce McCarthy, a very dear friend, who, as much as anybody, taught me what set me on the course to understand the Fed better than most people.
Yeah, well, we all have our mentors, and we always have to tip a hat to them when they've sent us on a path. That's for sure.
Yep. Yeah.
Speaking of paths, if people want to follow your path, how do they follow you?
Just go to nationalinvestor.com. If you're not already on my mailing list, make sure you sign up. You're missing a lot of great stuff if you don't. I've got special reports I put out on the new fangs and commodities, specifically on gold, how to buy small cap stocks, a lot of that kind of thing. And the next one coming out very, very shortly that I've been promising will be a uranium-centric special issue.
Perfect. Well, we continue to live in interesting times, and no shortage of things to talk about. So I look forward to our next chat.
Me too. All right. Take care. Have a good weekend, Mike.
Yes. Enjoy your long weekend, Chris. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.